Welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the dollar index is pulled back and it has engulfed its 5 previous candles right here. Again, this is just typical market behavior. Again, markets don't ever continue to go up indefinitely. Never works that way. You always have this uptrending cycle of going up a little bit, pulling back a little bit, going up a bit more, perhaps, and then you kind of pull back a little bit. Again, this is, when you're trading in an uptrend, you're not always exactly certain that this uptrend will perpetuate. At some point, uptrends eventually turn into downtrends, but for right now, it is a no-brainer. We are still in a pretty strong uptrend. Again, the fundamentals really haven't changed economically. The stock markets are having a hard time gauging exactly whether or not these politicians will execute on austerity immediately or wait 10 years down the road and go bankrupt. So we're in the either-or situation. But you cannot inflate an economy indefinitely. It doesn't work that way. Because you can't lend money indefinitely because you only have so much money to lend out. You need actual capital growth. You actually need business growth. What I'm trying to say is you need an increase in consumption and demand. And you also need an increase in production. And I'm not talking about production in the sense of manufacturing. Manufacturing is a long gone dead business in the United States. I'm talking about production in the sense of working, okay, just being able to produce intellectual property and stuff like that. So essentially, the U.S. is more of an information service-based economy now, right? And manufacturing can't be a major pillar of the U.S. economy anymore. So again, what we're relying on is more consumption, but in a sense not just the consumption side of it, but we also need real growth in the supply side as well. We need people producing more services and becoming more competitive in this economy. So what we really need is real economic growth. This is the main point. We need real economic growth. We don't need inflated growth. We don't need money being pumped in so the GDP is inflated growth. What we really need is actual natural growth, and that's going to take some time. And right now, the central banks aren't willing to risk any more quantitative easing, any more of those unnecessary programs, because not only have they proven themselves not to work, what you get in return is inflationary CPI increases without any wage growth. So wage growth lags while the cost price index tends to go up, and that's because of market behavior not coinciding with Main Street behavior. So Wall Street likes to do its own thing in reaction to certain events, but Main Street still functions the same exact way. And until this consumer price index, the spread between the consumer price index and the wage growth index, those kind of have to narrow at this point. And we're not saying that. What we're seeing is the consumer price index continuing to trend upwards, whereas the consumer price index is continuing to trend upwards, whereas the wage index, or how much people earn, is continuing to stay flat. So as soon as the spread gets too big between the consumer price index and the wage growth, that's when you have a huge problem, and that's kind of the issue that the central banks are realizing for once that they're making. So at this point, the solution is to halt that commodity-based bubble and that hype is to end quantitative easing and also to enforce fiscal discipline, or in other words, to get rid of moral hazard. The moral hazard is caused by politicians who stay in office because they spend a ridiculous amount of money. When you allow them to spend a ridiculous amount of money by enforcing that behavior, by asserting that, oh, I'm a central bank, I'm going to help you out. The issue, though, is that the longer they perpetuate this problem, the longer they keep on compounding it, eventually you're going to get a humongous default, which will rail the economy off the road. which would make currencies vastly more valuable, because again, the stock currency still exists, but all of the M2, M3 would cease to exist, and the $15 trillion bond portfolios that people have in the European Union would well, not even 15 trillion. It's starting to look something like 30 trillion. But even so, those ridiculously humongous bond portfolios will go bust. And essentially that's what would cause one of the world's biggest bank runs, because everybody in the world would have lost a substantial amount of money holding on to government bonds. And by doing so, you would contract the remaining currency immediately, and all other assets would rapidly deflate in valuation, because you'd have a sudden shrinkage in currency and a sudden shrinkage in asset value, and the value of everything else relative to treasury bonds would have to go down. That's the way it works. Now, if you want to disagree with me, that's totally fine. The only problem with disagreeing with me is that you would lose money. Essentially, you would lose money. And number two, you'd be misleading a lot of other people by saying something contrary to what actually happens. Now, I built this fully informed trade on the belief that I'm going to tell you what I believe is going to happen based on sound, realistic assumptions of what's actually going to happen, based on the fact that I want to predict what is most likely going to happen. And what I believe is most likely going to happen over the near term is austerity. And I think central banks will continue, and I mean this quite literally, central banks will not bail out the governments. Why? Because later on down the road, what we want as bond investors is that we want the governments to pay us back our money. That's it. That's what gives us our faith in the bond market. It's the government's ability to pay us our money back. Okay? Central banks, by continuing to lend money to these governments, they get rid of the incentive for governing officials to pay us our money back, and that's why the credit ratings continue to go lower. Okay? So AAA rating becomes AA, AA becomes A, it continues to go lower, lower, and lower, and lower. Main reason why is because we want our money back, and if the central bank continues to lend money to these governing officials, they'll continue to spend it. And the only reason why governing officials continue to spend the way they do is because if they don't, they won't have a re-election. They won't be re-elected. Why? Because the sheer amount of money that you need to cut in spending immediately to get a positive account balance would kick you out of office. Quite literally. It would kick you out of office. Because that's how negligent the financial behavior has been in these government offices. So these central banks are forced to have discipline, because if they don't have discipline, later on down the road, this behavior will compound into a bigger issue of perhaps $30 or $20 trillion worth of bond portfolios suddenly losing all value. And by that happening, you would have a rapid contraction in credit, and that would plunge the world economy into a really extreme recessionary, depressionary state. And because of that, the central banks have to exercise much more caution, and based on that, this is kind of like Nash equilibrium. If this happens, should we do this? What would be the most beneficial based on all parties? What do we all want collectively? The bond investors want to be paid back. The government still want a functioning government, and the central bank wants a functioning economy over the long run. I'm not talking about, what might work for what, 2, 3, maybe 4 or 5 years, maybe 10 years at most, but we're talking about something that will work for the next 100 years, okay? And to fundamentally solve the problem for the next century, not for the next decade, the next century, that's what's important, the next century, the next generation, okay? We had to solve a problem for the next century. And either you do it now and experience a huge blow to the economy, or you allow this issue to compound for the next 10 years, and you create a death-crippling blow to the economy and to the bond investors and to wealth. The very key theme of what wealth is. You would destroy that perception immediately if the bond market were to collapse 10 years from now. Okay, so that's what's at stake. Now let's talk about the Dow Jones Industrial Average. Dow Jones had a nice little rally today. The fundamentals haven't really changed that much. The main reason why a lot of shorts are covering is because they kind of want to get out. It's the end of the year. They want to take their profits. But not only that, asset managers want to show that we've actually been able to flat it. We were able to get out flat. So in 2011, we started right here. And it's better to show a 3% or 2% gain or 2%, 3% loss than eventually what we're going to see in 2012, where markets could continue to go lower and eventually reach down to that 10,500 area somewhere in quarter 1 or quarter 2, 2012. Euro US dollar, okay, this is just a day chart. We have a head and shoulder pattern in. Once this breaks down below the 1.307 area, 307, we could see around maybe a 40 pip decline into the 50 right here, the 50-day or the 1.3050. Again, that could be around a 30 pip gain right there once we see that neckline broken. So again, this is just intraday analysis. Again, this isn't very important. The longer term though is we've had a nice little bounce. We're still below the 200, the 50, and the 20-day moving average, so we're statistically on a negative downwards trend. Okay, the Euro Japanese yen. This is a little different. We've had a small little bounce, but it retraced backwards. Again, the main reason is the bond trade in the European Japanese yen markets, going from the euro into the Japanese yen and the Japanese yen going into the Japanese treasury market. Treasury yield, treasury appreciation with currency appreciation, it's a no-brainer. The Euro-Japanese yen trade is still on. I still think banks are going to continue to diversify out of the euro into the Japanese yen and continue to earn a nice little spread on yield. Talking about the silver market has continued to go on a downwards trend. Again, we've had a nice little bounce, but the long-term trend is still negative. We're below the 200, the 50, and the 20-day moving average. The trend is still negative. Stay away from silver. Gold. Gold has had a nice little rally. I do think we're going to hit the 200-day moving average before we pull back again on gold. So watch out for the 200-day moving average. Don't be a buyer into that 200-day moving average. If you're a short-term trader, buy it, hold it to the 200-day moving average, sell it, get rid of it, get some profit off of it. United States oil, again, we ran into the 200-day moving average. I think we're going to retrace from that 200-day moving average. We're still below it. Again, we did get above that 50-day moving average, but we're still running into that 200-day moving average. I wouldn't be a buyer. I'd avoid oil. Take care, folks. I hope you guys have a wonderful week, and see you guys some other time. Bye.